Interest rates are the tail that is wagging the stock market dog right now. Are interest rates done rising? And if so, are stocks done falling? Let's see if we can employ some of our Wyckoff method technique and try to determine where we are in the big picture for these very important related asset classes. But first, let's talk about the Wyckoff market discussions, which are every Wednesday afternoon, 3 o'clock Pacific time. They are recorded. When you attend, we just immerse ourselves as a community in the Wyckoff method. We talk about current markets and stocks and talk about special interest items. Our attendees will submit charts and we will go over them together, which I think is remarkably valuable. Ramon's an exceptional Wyckoff tactician, and it's just really a great time. So at around the end of this month, around the end of the quarter, we are going to have a free session. You can watch our beginning of the year session by going to the website, but you can join us live here at the end of the month, and I will inform you when we have all the details worked out. This chart, which we put up at the beginning of the year, I think was a very important chart. This chart was first drawn January 4th. This is U.S. Treasury 10-year yields. We did point and figure analysis on yields. Point and figure analysis is a remarkably robust technique. We can use it on a number of different data sets and get a lot of useful analysis from it. So here you can see a large distribution, and this gave us a down count. Let's go back out again. This count amazingly took us from about the 3.25 interest rate area. This is back in 2018, and counted down to a count of 1.26% down to 0.62. This put us right into the range. Look at this beautiful target range that it put us in. At the beginning of the year, I talked about this in the power charting episode where we looked ahead at 2021 and said at the time, and this is the exact chart I showed you, that we had these counts of rising interest rates, 3 different segments we call them. And here you can see segment A, segment B, segment C. Wow, and segment C goes all the way back up to the 2018 interest rate level. Also, just note, redistribution here confirmed the distribution count, which really helps us to have confidence in our analysis in our price, or in this case, interest rate objectives. So here we have a count that went 80.80 down to 0.48 yield. And this beautifully picked up the lows. Now, what in fact happened after the January 4th area? You can see that this is an important resistance area along here. It was about to jump out. We picked the exact right place to draw this chart. A pat on the back, but look what happened. Let's blow this back up again and go over here, and we can see, look, right away it went into an upthrusting action out of the accumulation area. And we know that when accumulation is complete, there's a massive imbalance of supply and demand. And in this case, the demand was for higher interest rates. And so it's a little convoluted thinking with interest rates. And I know it's going to be a little bit of a struggle for us to be able to invert our thinking. But look, we had a count that took us up to 154, and notice this catapult wall. Look at this incredible run up, just straight up, grinding upward up to 1.54. This is exactly where our count for segment A went to. And so this chart went right to that area, and look, we've already had a pullback. We're stalling at this area. Now we may work our way up into the area of this count objective, which goes as high as a yield of 1.92. And then it's because we have higher counts in this accumulation area, we may get, I expect that we'll get a reaccumulation for higher yields ahead. And so here you can see accumulation structure complete in the range of the first segment objective, additional segments with higher counts, higher yields, and yields now accelerating. Well, that was up into this area here. It's still, they're very stiffly rising. Well, this could have consequences, and well, it already is, because we can see the stock market is really struggling with the stiffly high rising interest rates that we have here. Let me show you a different look. You have not seen this chart before. This chart is U.S. Treasury, 10-year U.S. Treasury note prices. So this is the futures contract, and this is the Treasury note price. So when prices fall, that means interest rates are rising. That's what we were just looking at, was rising interest rates. So we can see here a distribution count has formed. We have two segments that we've identified here. The first segment goes down. Now this is a count that goes from the 140.25 price level with a count line at 138.25 and counts down to 132 to 130. So that's a pretty stiff decline. Well, look, we're already down to 133.25 here. Now you can see the scaling. It's a 3-box method, quarter point scaling, because bonds tend to move in smaller increments, and we want to capture all of the essence of the volatility for counting purposes. And I also want to point out, look at this beautiful reaccumulation count here. This was the redistribution count on the yield chart, which you just saw. And I'll probably write this up as a blog so that you can have access to these charts more easily. But here you can see, look at this beautiful count up into the range. It perfectly hit the highs at 140.25 on the extreme price objective count. And so now we have two segments. The first segment is only 1.25 away from where we are. And we have 129 to 127, which is the larger count of this distribution area. And this makes sense because look, here is a support area. So we as Wycoffians would expect a move like a magnet towards support, probably go through the support area by a few boxes, which would be exactly into the count zone, and then have a more important rally. Now, when we get into the first count here, this is often a place where there's a pause. We see that we're already into the count area on this chart here. We're already at the edge of this count area. We may work our way up in here somehow. We don't know exactly how. And that probably is a stopping action for a period of time for yields. Okay, I'm talking way too long on this, but it's important. And here's the reason why. This is interest rates in the 1980s. And it's like one of the better examples. I showed this to you briefly last week, but I want to go back to it. This is, again, yields. So falling yields, falling interest rates. Market loves that. You can see the market's going up and up and up. This is in the early to mid 80s. Now, I want to point out that right about here, well, maybe late 83 actually, was the end of an IPO boom. And there was rotation towards the blue chip, larger cap, more stable demand, institutional in economic stocks and away from the growth segment. So here was this whole big move in the S&P in sort of we used to call them the dirty 30. So these are like the institutional names that drive the economy, the transportations, industrial, et cetera. Okay, so now this was already taking place since way back here where growth was starting to fall away. But look at this base in interest rates. So a base formed, look, it's classic Wyckoff accumulation, and that means in this case, invert our thinking, interest rates are going to rise. And so here, notice how interest rates were rising, and we can see that the interest rates were going up, up, up. And here we had about a 20%, now this is over 13 weeks, a 20% rise in interest rates on a rate of change basis. That means on a 13-week chunk of time rolling, we had interest rates rising at a 20% rate. Pretty darn stiff rate of increase for interest rates. So here and here, so rates are rising quickly. And into this second rise of interest rates here, we had a top. This is August. Here is the October test. This is the 87 crash. I was there. It was amazing. I don't want anybody to ever have to go through something like this. And we can talk about how to be defensive and how to protect in the event of this kind of thing happening. Maybe it's a subject for a future episode or a blog. But you can see here that interest rates fell after the decline of the stock market, and then it got a hold of itself, built a base, and then started to go up again. So this took a couple years. So anyway, where are we now? So now we can see this has a very similar look here to what we saw in 87. This is 2020. And we can see here that the rise of the 13-week rate of change is a much higher clip, but interest rates are much lower now. Rates got upwards of 8, 9, 10% in 87 on their way to the final highs of interest rates. Here we're talking about rates that are at 1.5%, so significantly lower. But the caveat is that stock prices and stock valuations are richer. They are higher today than they were back in 87. And so stocks do have very high valuations in them, especially the growth stocks. So keep that in mind. And so here we can see that this base has resulted, and we just did a count on that. We had it going up to the area that it's at right now. This is the count, or the interest rate count that we took. And we have counts that go as high as 3.2%. Now, it could take years for that to happen, but if at all, it may not have to happen. But we did just fulfill a very important accumulation right here. Now, we have seen weakness come up in the stock market. This chart's as of February 25th, so it doesn't show some of the recent weakness that we've had. Now, just finally, I want to just show you the comparison between these two periods. Big, beautiful base in rates here, big, beautiful base in rates here. Both resulted or are resulting in a steeply rising interest rate structure. And I think it's the rate of rise of interest rates that is difficult for the market to deal with. Stocks struggle with rates that are going up quickly. And so if they go up in a meandering way, the market can digest that much more easily than rates that are going up very stiffly. And that's the reason I put here the rate of change on interest rates in the chart, because I want to see how quickly rates are rising on a basis, in this case, 13 weeks. It's a quarter of a year. I like to look at quarters of the year. So here you can see the big rise in 87, the big rise that we've just been in, and now we're starting to come down some. So how, here, this is just to give you contrast, and this chart is up through today, and this is high yield bonds. The price of high yield bonds. As the price goes up, that means the yield is falling for this portfolio of bonds. High yield, in contrast to treasuries, is really a sensitive asset to the economy. And when high yield bond prices are rising, that generally suggests an outlook for the economy that is positive going forward. And that's exactly what we have. So high yield bonds are telling us that the economy is getting better. Notice this, though, that we are about in the area of fulfilling our upward price objective. Now, that doesn't mean that these bonds have to go down, but I believe it could mean that we are for the foreseeable future in a trading range. So I think the event here, which says that the economy is in pretty good shape, but I think it also says that these high yield bonds are done rallying for the foreseeable future. Now they may build a cause for another rise, so we will watch for that. But two confirming counts that say this up move is over. The other thing that we have here, and this is sort of the arch enemy of interest rates, is inflation. Here's a measure of inflation. This is like crude oil, so WTIC. And we've done point and figure charts. I've done a number of blogs in the past. Crude oil just really works well with point and figure. I'm always quite impressed. And here's a perfect example. Here's distribution with a high price of $76. And this distribution counts all the way down to $7.60 to minus $3. Now, in fact, we all know that crude oil went to negative numbers momentarily back during the COVID decline. And so here's our point and figure chart saying a negative price for crude oil. How did it know? So here's a really big COVID base, crude oil with a count line of 34.96. But notice that this count, this is 3-box reversal method with ATR scaling, counts up to 85.12 to 112.48. This count, or when I did this count in January, was the crude oil was about 53.20 a barrel at that time, and now it's about $10 higher than that. So it just keeps grinding its way up to these higher objectives. So we'll keep an eye on that. But this is doing so far a really good job of telling us the potential for interest or for crude oil to go up. And this really is sort of the arch enemy of interest rates. They tend to work in opposition to each other. Now, I do want to talk about distribution here. I'm just putting these up so you can see them. Go to this blog post where you can get these charts, and I'm going to talk about these structures of distribution this week and next. I might as well keep talking about it because there's some really interesting stocks that we have to look at that have distributional structures. And so I'm going to go through some of the key points about distribution as we go here. But this is, again, you've seen this chart over and over, and I love to call out Roman for his great work. This is a really fuzzy chart. This is this is not that old thing about what was it, Twilight Zone, where don't adjust your TV. It wasn't Twilight Zone. What was it? But anyway, don't adjust your TV. It's like, it's kind of fuzzy, but you get the point. This is the whole trading cycle: accumulation, markup, distribution, markdown. And so here, and we count this, we build scenarios with our chart work on vertical charts, and then we count the distribution as we do the accumulation and get objectives for these lower count objectives and higher count objectives. So here is an example. This is the S&P. I don't believe I've shown you this chart, but this is 3-box reversal method, 20-point scaling, daily data. Now, here is the COVID accumulation structure. Believe it or not, in a very short period of time, there was a large accumulation count. The count line here is at around 2780, and it counted up to a range of 3580 to 4160 with a midpoint of 3870. If the range is pretty wide, we put in a midpoint. Then we had a reaccumulation count, a couple of them. Look at how this one counted right up to where the stopping point was. Look at this big climactic surge, stopped the advance right in our count objective range, gave us a reaction. We took another count here, counts 3760, 3940, which confirms the larger base accumulation count. This is just beautiful stuff. This is exactly what we look for. What a beautiful trade here. And it was well flagged and well indicated by our point and figure work. So far, what I see is a high of 3950, which is just 10 points over the high of this count and still within the high range of this price objective. Now, you haven't, I believe, not seen this chart before, but this is my secret working count for the bull market. And I'm going to show it to you, but you got to keep it to yourself. This is the SPYs. This is just for Wycoffians. And this is the distribution count off the 0607 top. And it just missed here, hitting the shakeout low by about 2 boxes, pretty darn good. We had other distribution counts that actually hit it perfectly for other indexes, but this is good enough for us. And here, this was a count of the accumulation area. Look at this beautiful accumulation that went through 2009 and gave us a count up to 225, 245. This is on the SPY. And here, this count, which is shows a backing up action to the top of the accumulation area. This count stretching all the way across to the climax gave us a count up to 370 to 410. And look at where we've gone to 394.17. I do believe that that's the high touch on the SPY so far. Wow. That's a great hit right there. Look at that. And this count is multiple years and a beautiful accumulation and a backup. We have a couple of really nice reaccumulations. And here you can see that this accumulation, this is the COVID accumulation area, and we've gone right up into that 380 level. We went through over the top of it slightly. I could probably stretch this count out maybe to here. I've done it on some of the other indexes and it's worked pretty well. But anyway, wanted you to see this. So now let's drill in. We've only got about 5 minutes left. I promised to pick up these charts that I have. Next week, I have some individual stocks to show you and some dazzling point and figure on stocks like Tesla and Apple and so on. And they're really just cool charts. But here's the Dow 15-minute data, ATR scaling 77.12 scaling, 1-box reversal because we're looking for swing trades here. This is an upthrusting action and a rally back up to this very important resistance area. Look at all these touches right here in these 2-box areas here. So I counted across to here, 24 columns, counts down to 3153 to 29,768. So this is as of the 3rd. And so we'll keep an eye out for this. And I believe it's possible, and I've said this before, that this could be a bigger count. We would have to widen out our data. but this could be a bigger count. I don't know. We will look at some other indicators to help us. Now, here's the Nasdaq comp. Nasdaq comp 10 minutes. This is 3 box reversals, so we're looking at more data. 38.93 scaling, which is ATR. That's pretty big scaling on a 10-minute basis. Look at this beautiful distribution structure. So notice how we can count these little areas here. This is a distribution in its own right. We talked about this in, and I do want to show you, actually, let's just do this right now. Oh, shoot, I didn't put it up. Oh, well, so we'll do this next time. But anyway, go back to the January power charting. And in the January power charting, you will see the interest rate chart that I did. And then also go back and look at the point and figure part 2, because I started talking about the top that was building the overbought condition and the divergences that were occurring in the market. I think we did a really good job of identifying the risks at the top there and talked about them right here on power charting. You were there, so we I think our Wyckoff tools worked well for us. Okay, we only have 2.5 minutes left. Here is, look at this count. Look at how it stopped the decline right here. Beautiful count. And then we had another redistribution count, pretty conservative count I took, takes us down 12,535 to 12,301. But look, if we take all the way across from the last point of supply to preliminary supply, 35 columns, we get 4,087.65 points of downward objective. Now, what would have to happen is we'd have to break the support area right here, which very well could happen, probably happened today. And this takes us down to 10,082,994.98. And that's more than a 20% hit to the market. And then finally, let's look here at the S&P again. This is a 30-minute chart. Notice the distribution here. This is through the 3rd, and you can see that this count goes 36.14, 35.76. And this is just a little swing trading intraday count, 1 box reversal method, and it generates a pretty good decline from here that goes down to the area of this support right here. But also notice that we could have a bigger count forming, and so we want to really be on our toes and also look at larger data sets as we go. And so just to give you a preview for next week, this is I want to talk about distribution in individual stocks. One of the big points I want to make is that these stocks will form distributions super quickly. Notice how from January into mid-February, you had a distributional structure form. This could be even a larger structure that goes way back to here. But if that in fact is all distribution, here is a count for that area right there. And look what we have. So this count right here, 17 columns, this is daily data. This isn't intraday. This is just regular daily data, 3-box method, standard scaling, takes us all the way down to 645 to 565 in Tesla. We've already exceeded the minimum price objective area. So we're going to talk about this more next week, and I have a much bigger count to give you at that time on Tesla, a much bigger case study. But anyway, with that, I'm going to go. So glad you were here, and we'll just keep going, do this next week. Have a wonderful week. Talk to you then.